I'm Kyle with Fundamentals of Finance, and today we're going to dispel some common mutual fund myths from YouTubers who have no idea what they're talking about. Another lesson in why you should be careful where you get your information from. If YouTubers can say,
"The earth is flat,"
then how do you know the investment information on YouTube is always accurate? Well, it's not. Let's dive in.
They significantly underperform the market in the long run.
Besides the fact that this is blatantly not true for some active funds, index funds essentially track an index, or the market, with extremely low fees. So how exactly is he coming to the conclusion that they all significantly underperform in the long run?
This is the return that they can get if they invest in an index fund that mirrors the general market performance.
Oh, I get it now. Wow, he doesn't even know what a mutual fund is. You see, an index fund is just a type of mutual fund, like how basketball is a sport. Well, it's a good thing over 35,000 people listen to what this guy has to say. The rest of this should be great.
A recent CNBC article published in May of 2019 revealed how the majority of active fund managers underperformed the S&P 500 for the 9th year in a row.
Okay, if he doesn't know that an index fund is a type of mutual fund, he definitely doesn't know this. Actually, very few people do know this, so get ready to have your mind blown. That article that CNBC puts out every year references the SPIVA scorecard, which is totally biased and has a whole bunch of flaws. First, they don't always use funds' actual benchmarks. They use ones they have assigned based on the category they think a fund is in. But the bigger problem is that they use each fund's share class with the most assets instead of its lowest cost share class. Most mutual funds have many different share classes with different fees. And those additional fees usually do not go to the mutual fund company. They might go to the financial advisor as payment for their advice, or they might go to a company to subsidize the cost of providing a retirement plan for their employees. But this study essentially takes fees for other things besides managing your investments and subtracts them from the active manager's results. Why might they want to bias their results in favor of passive index funds? Well, who produces this study? S&P Dow Jones. How do they make money? They license out the rights to their S&P and Dow Jones indices to index fund and ETF managers who want to track them. The more people who want to buy index funds tracking their indexes, the more money they make. So they have a strong incentive to make active funds look as bad as possible. That's like reading a study about the health benefits of milk that was put together by the dairy industry. You should question the findings. I'm not saying every active fund beats its benchmark over time, or even the majority of them, but these numbers are way off.
And over 15 years, nearly 92% of these underperformed. And in order to simply beat the market, you'd have to be among the top 8% of mutual funds, which is nearly impossible to pick in advance.
Okay, A, those numbers are wrong, and B, it's really not impossible to find good quality funds that consistently beat their benchmarks over long time frames. He might not be able to, but it can be done, and I can show you how.
Mid to small cap simply means that they're managing less than $10 billion worth of assets.
No, it doesn't. It means that they invest in small companies. It has nothing to do with how many assets are in the fund.
But you might be wondering, what exactly is the reason behind this underperformance? Honestly, there are too many factors to get into in this video.
Read. I don't know what all the factors might be, so I'll just say there are too many to discuss.
And since these mutual fund institutions hold so much money from so many people, whenever they make a buy or sell purchase, they're actually going to drive the market up or down.
No, not really. Mutual fund traders go to great lengths not to move the market when they make trades. It can happen, but not remotely to the scale he thinks, and especially not in largely widely held companies like Apple and Microsoft.
In recessions, this would cause absolute mayhem with everyone selling out of the market. When everyone sells out of their mutual funds, this will cause the market to drop, and the ones that still stay into their mutual funds will actually have to suffer all of these losses.
This isn't even a mutual fund myth, but like, what? Well, why is this guy making a video about mutual funds when he has no freaking clue what they are? I don't know where to start with this one. Mutual funds are just baskets of securities like stocks or bonds. The prices of the stocks or bonds they hold are the only things that impact the mutual fund's price. It works the same way with ETFs, index funds, or individual stocks. They all fluctuate in price, and they all mostly go up over time. I don't understand why he's making it sound like only actively managed mutual funds have prices that go up and down.
An absolute most important reason why you should not invest in mutual funds, and that is because of the high fees.
This is probably the most common myth. which has been spread by proponents of passive management. I'll show you 2 ways people try to make this case. First, they can find something egregious like,
So I found this one article online from Advisor's Edge, and it simply said that mutual funds cost investors more than $300,000 in a lifetime, while the average balance of an investor's account is only $229,000.
wow, so mutual funds take over half your money in fees? No, not exactly. I'm not sure if this guy just can't read or he's blatantly lying on purpose. But if you actually look up this article, it's about Canadian funds with an expense ratio of 2.35%, which is almost unheard of in the United States. It assumes a return of only 6.5%, which is way under the historical stock market average of more like 10%. And here's the real kicker. The average account balance is based on this hypothetical investment over their lifetime, starting with a $10,000 investment and taking withdrawals in retirement. So yes, if you bias the fees way up, the returns way down, and show the average account balance after taking a bunch of withdrawals, you can make any investment look bad. But even much more reputable YouTubers like Rose sometimes have good intentions but just don't totally understand this industry and let their bias creep into their videos.
Actively managed mutual funds charge an annual fee of 1 to 2% of your account balance every year.
Really? I wonder where she got that information. She doesn't say, because according to the Investment Company Institute, expense ratios have declined substantially since 1996. And where were they in 1996? 1.04%, barely within her range. That's like saying the average car has 25 horsepower. Well, yes, they did in the 1920s. But that's not where we are today. Even Priuses have more than that. And just like cars, mutual funds expense ratios have come a long way. And before you say that's just because of the rise of low-cost index funds, you can see that even in 1996, the average expense ratio of active equity mutual funds was only 1.08%. And now they're down to 71 basis points or 0.71%. And even that number is a little biased upwards because first, expensive C shares still exist and impact the average, but no one should buy them anymore. Second, this is only for equity funds, but bond funds are usually cheaper. And third, large funds with a lot of assets are also usually cheaper than average. So you can do better than 0.71% and certainly better than her made up 1 to 2%.
So you could literally end up with less money than you started with, but the fund manager would still get paid millions of dollars for their services.
True, you can lose money on any investment, not just in actively managed mutual funds, but then basically in the same breath of you losing money, she says that
over the years, fees will reduce your nest egg by hundreds of thousands of dollars.
And for that to happen, they would have to make you millions of dollars because remember, you're very likely to be paying less than 1% per year.
So the vast majority of mutual funds are totally not worth the high fees.
Well, there's something we can agree on. That's why I don't advocate picking funds at random. But some actively managed funds don't charge high fees and are well worth what they charge. And people like these may not have the knowledge or experience to be able to help you find them. But I do, and I can. So in my professional opinion, no one should listen to Nick. He is way out of his depth. If you just want to be average, Rose gives lots of solid advice and you could do a lot worse. But if you want to take your investing to the next level, click that subscribe button because I'm here to help you do that.
The fund follows a fixed formula that totally eliminates the need for someone to make buying and selling decisions. The formula that it follows is based on an index.
And how do indexes choose which companies are in them? There's someone there making buying and selling decisions, or technically inclusion and weighting decisions, since indexes themselves don't actually own the companies in them.
Except for one major difference. With index funds, you can only buy and sell shares once a day. But with ETFs, you can buy and sell your shares whenever the stock market is open.
She's right about that difference, but she's very wrong that it's the only difference. Actually, the main difference is that ETFs are more tax efficient, at least if you have them in a non-retirement account with no tax advantages. For more on that, you can check out my ETFs versus mutual fund videos here. And if you want to learn the 9 habits that will make you a more successful investor, check out the link below in the description. Thank you so much for watching, and I will see you in the next video.